Good morning, Jags. This is Fahad. Today is Tuesday, March 16th. Let's get started. For several weeks now, actually, I should say for several months now, we have continued to push in the direction of value, reopening, recovery stocks. And in that theme, we have made a killing trading call options in airlines and Boeing, trading call options in hotels and OTAs, online travel agencies such as TripAdvisor, Expedia, and so on and so on. And so going in the same direction, I think it's time to take a closer look at Las Vegas Sands. Now, this should be pretty obvious to everybody, but I think it's worth noting a couple important things that may not be on your radar about LVS. The first thing I want to point out is that yesterday in the afternoon, within the last 2 hours of trading, if you look at this open interest, you will see more than 17,000 open interest in the September 67.5 calls in LVS. More than 15,000 of this was bought to open yesterday for up to $7.75. That is $12 million in bullish bet in LVS September 67.5 calls. By such a close observant of the option market, I can tell you that this is probably the largest bullish bet I have seen in LVS, possibly since the pandemic began. And I'm sure if we're going to see in LVS, we're going to see similar kind of flows in Wynn Resorts as well going forward. But LVS is a unique story that is appearing in front of us. So I'm going to dive into that. So $12 million of bullish bet in the September 67.5 calls yesterday. Now, purely on a technical basis, if you look at the chart, it has been rising, trending is strong with the recovery stocks, consolidated in a tight bull flag for the past 3 weeks. Yesterday was a power candle on volume surging, and now starting to break out yet again. I think this is going to about $80 to $85 per share. There's several things that you need to keep in mind. Number one, this news that came out on February 23rd, this was about 4 weeks ago, where first time in over a year, China decided that they're going to lift the travel restriction in Macau for people coming from mainland China. And what this means is that you're no longer going to be required to quarantine for 14 days if you're entering into Macau from mainland China, effective February 23rd. Now, since this happened so late in the month of February, it didn't really benefit the February GGR, which was the last report that we got. But I think you're going to see a substantial increase in the traffic in the GGR for the month of March, which comes out at the end of the month. And so when March month ends in about 2 weeks from now, I expect March GGR to jump sharply. But prior to that, through the end of February, GGR was down more than 79% year over year. And I think that is the bottom in LVS. So that's the first thing that came out. The second thing that you need to keep in mind is that there is a fantastic study that was done by Stifel Research, in which they looked at all of these reopening plays of various kinds, particularly in the travel sector, to see how many of them have returned back to their 2019 high, or how far down they're below that. Now, all of them are naturally up substantially from their pandemic low, but many of them still have to recover back to pre-pandemic high on hopes of continued recovery. Las Vegas Sands and Wynn Resorts still have substantial amount of grounds to cover by as much as 13% and 18%, while many others, as you can see, Penn National Gaming, Bali, Scientific Games, Boyd Gaming, Caesars, Vail Resorts, all of them have already recovered and they are above their 2020. Similarly, if you go to the actual Macau, and this is the key chart that you want to keep in mind, take a close look at that. This is telling a story where you can see that for nearly about 7 to 8 months, starting from February of last year up until September of last year, Macau revenues were essentially zero, right? We were down 85, 90, 95%, more than 90% for all of those months. And then we increased slightly off the low base effect. And then through February, we have started to see revenues are still down, GGR still down by about 80% or so. But now that the restrictions have been lifted starting from February 23rd, I expect a sharp surge in Las Vegas Sands and Wynn GGR. is starting immediately from the month of March. How much that this will actually return into a 2021 GGR growth rate of 170 to 220%. 170 to 220%. Naturally, this is because of the low base effect, because the revenues were essentially zero in Macau, and where you're doing a year-to-year comparison. But this is exactly how the multiples expand before the growth rate start to peak. So how far can the earnings actually go higher? The street is starting to warm up to this, and this is exactly what we are looking at. For fiscal year 2021, Las Vegas estimates have changed just within the past couple of weeks from $7.32 billion in revenues to now expected to be $8.5 billion. The property EBITDA has gone from 1.87 billion to 2.56 billion. And what was expected to be a full year net loss on the EPS line is now expected to be a 66-cent increase. All of these estimates started to change, and this one comes from Stifel just within the last couple of weeks. Similarly, if you market is going to start to forward look to 2022 pretty soon, after especially summer is over, and you can see that 2022 EPS has also gone up from $2.09 to now $3. This is how the growth inflects and turns positive. Another thing that you need to keep in mind is that Las Vegas Sands is now a very clean story, possibly even better than Wynn. Now, I never thought I would say this because I've always preferred Wynn as the way to play the gaming sector, because Wynn is a far better run company, in my view, with many better properties and everything. But what has happened is that Las Vegas has now sold, effective last week on March 4th, Las Vegas Sands sold all of its properties in the city of Las Vegas. Maybe they should even change the name of the company now, because it no longer has any presence in Las Vegas. They sold their Venetian property. They sold their bunch of other properties in combination of that for a total sale of $6.25 billion to a private equity firm, combination of actually private equity firm called VC and Propco. And it was sold for 9.5 times 2019 EBITDA. If you think about it, how expensive the property was sold for. So while we're still down substantially on a year-over-year basis, and a lot of the revenues are still suffering, even though Las Vegas Sands has seen now an improvement in traffic because Nevada has increased the capacity from 25 to 50% within the last week. But these properties, the sale basically tells us a story that these properties are not selling based on what the current trends are. They're being sold at a premium based off of what the 2019 normalized rate was. And so based on the 2019 EBITDA, which was well before pandemic, at a prime time when we had 3.5% unemployment in the country, based off of that, this property was sold to private equity firms at 9.5 times 2019 EBITDA. That tells you that there's demand out there, and there's investors that are piling into this. They're expecting a quick return back to normalized trend, and for that reason, this stock should return back to how it used to trade previously. So expect multiple expansion to continue, and expect the stocks to continue to get re-rated higher. One more thing, this is the technical chart, the same chart that you're looking at, but here is a clear-cut VOP resistance of $66 per share. Also, and this is the last kicker, many people probably don't know this, but in February as well, right in time, excuse me, right in time as China lifted the 14-day quarantine restriction in Macau, phase one of a brand new property of Las Vegas Sands in Macau opened. This is just phase one. It's called Londoner, which is based off of United Kingdom's theme. This is what that picture looks like. This is the phase one of the property that just opened. This is what the front looks like. And then you can see there are two towers behind it. This opened in February, only phase one. This is the second chart of that, probably a much clearer picture. But you can see that this is what this property looks like. According to a press release that came out from right over here, and this is on February 8th, in this press release, if you read the whole story, you will find out that they talked about that various phases of this property will gradually open throughout in the course of 2021, just as the traffic will be improving throughout in Vegas. That's a kicker, not Vegas, sorry, in Macau. That's a kicker to the upside because Las Vegas Sands is now a pure play on Macau and has no presence. And one last thing I will also tell, there was a conference that took place, which was the JP Morgan Gaming Conference on March 11th. This was last week on Thursday, in which the CEO presented, or the incoming management after Sheldon Adelson is gone, and they said right over here, our Londoner, as you know, is nearing completion. It's pretty extraordinary. The market, I don't think it understands what's happened to Londoner. Those who have seen it, our competitors now know. And the same deal with our Four Seasons. We believe Macau is a big growth market for us, far beyond what we are doing previously. We would love to deploy more capital in that market. As you know, we have a contract with the government in Singapore to expand our business there. That's a $2 billion opportunity and growing fast. And so there's far more very, very positive coverage over here. And they continue to talk about how Macau is going to be a huge beneficiary for the company. So now you've got a really, really strong bullish play, fully based off of Macau growth, and they're sitting on a massive pile of cash on the balance sheet of more than $7 billion to deploy to expand operations in Singapore, in Macau, and other places while these growth rates are trending higher, accelerating, and restrictions are being lifted. And on top of it, you have the Londoner brand new property opening, and on top of it, you have massive amount, $12 million worth of September 67.5 calls being bought. So that wraps up my bull case. Lots of things to discuss. Let's go to Jay.
Morning, everyone. Just wanted to provide a quick update on PAR Technology, ticker PAR. I covered this name in the Weekend Research on March 7th. Essentially at that time, I thought the recent weakness we had seen in that stock was presenting an opportunity. So the company reported their Q4 earnings after the close yesterday. Just wanted to share some of those metrics with you. Overall, it was a good quarter. Revenues came in at $58.5 million, an increase of 10.6%. Now the company offers their Brink point of sale systems to the restaurant industry, if you're not familiar with the name. So on that topic, on the Brink's performance, new store bookings came in at 1,525, which was an increase of 67% year over year and 29% sequentially. Management said Q4 Brink bookings were the highest number of signed orders in a quarter in our history. They also note that historically that they have been able to turn a booking into revenue within 6 to 8 weeks. Brink's ARR came in at $24.7 million, which was an increase of 29%. It installed 885 new Brink stores, which was up 42%. And overall, it ended Q4 with 11,722 active stores and a reported backlog of 2,546 stores that are not yet installed. Management talked about how, this large buildup of almost 2,500 signed orders waiting to be installed. As the pandemic winds down, they said their ability to get into these stores should become easier and easier, and they're already seeing that. So what you're going to see is this backlog come down and ARR turn on very aggressively. The company also quickly highlighted their PAR Payment Services, which is their all-in-one payment process solution. In Q4, it was essentially the beta. And so in Q1 was really their first real quarter of selling the product. So we're going to have to wait a few months to get some data on that one. But overall, like I said, it was a good quarter, but you shouldn't lose sight of the long-term growth of this company. If I can just quote the CEO, Savneet Singh, who said, there are 1 million restaurants in the United States, 7.5 million globally that use point of sale systems, and they're building for that, and they think the TAM is absolutely enormous. So like I say, yeah, don't lose sight of the long-term outlook for this company. But overall, it was a good quarter. I'm seeing BTIG has a note out, essentially reiterating their buy rating and their $105 price target.
Jay, isn't this a classic case of bookings in excess of billings?
Mm-hmm.
Right. I mean,
Yeah, yep.
from what you just, it looks like the focus of your discussion here on this one, after reviewing this earnings report that just came out, is on bookings. I'm reading a quote over here directly from Savneet Singh, who is the CEO, the president and director of PAR Technologies. And I'm reading the transcript and quote, "We entered the year with the largest backlog in our history.
Mm-hmm.
That should set the foundation for a very strong 2021. Unquote. That one line tells the full story. Bookings and excess of billings. And when you've got that many signs that are just in the backlog, more than 2,500 just waiting to be deployed, that is also telling the same story. So low churn rate, accelerating growth rate as those bookings basically turn into revenues in the future, and a far better growth to emerge. So this is very, very positive on the stock, even though the stock has run up, potentially in anticipation of that. But based on comments like this, any downside risk should be very limited, and the path of least resistance should be higher and higher from here. Good stuff.
Yep.
Folks, this is the weekend research that's right in front of you. This was issued in the first week of March, in which the bull case was discussed for PAR Technologies. Full article, everything discussed right over here. All right, let's go to Chronicle.
Morning. Today, I wanted to sort of preview an upcoming top pick that's going to be in the Q2 quarterly outlook, which is also going to be a Jaguar Media video. Video is going to go out after the outlook is released, so we're not going to reveal the stock yet, but wanted to talk about the main drivers behind the idea. And then separately, I do have a related stock that I'm similarly bullish on, which I'll get into. So lately, you'll notice that we've been talking a lot about shipping. And I know recently we've been zeroing in on the containers market, particularly regarding the spike in container rates and how busy the ports of LA, Long Beach have been getting. However, to play a bit of devil's advocate, I do suspect that the container shipping market is close to peaking right now. I know based on commentary within the Asian container production industry that despite their order books being full until July, they do expect conditions to ease by early fall. So I think we might start to see some profit taking within the container space in the coming weeks as the markets look ahead and anticipate that the crunch will begin to ease. But in terms of derivative plays, I think certain pockets of trucking are in a sweet spot right now in terms of rates due to both the elevated imports as well as capacity shortages going on within the intermodal and truckload industries. And this is likely happening because of a combination of two things. First factor is that there's been a persistent shortage of truck drivers across the country, which has been further exacerbated by COVID disruptions and drug and alcohol clearinghouse training, of all things, but also because of stimulus checks, which have helped to disincentivize people from applying to the industry. And so reportedly, these complications have resulted in additional shortfalls of over 200,000 truck drivers at the start of this year. And this shortage is not going to correct itself overnight. Plus, we also have to consider that the unemployment benefits have just gotten extended. So that's one side of the equation. The other side of it is the anticipated infrastructure stimulus bill that's going to be coming which currently has bipartisan support. So basically, to sum it all up, one, we currently have a lot of containers waiting to be transported from the biggest ports facing the Pacific. Number two, we have a shortage of intermodal truck capacity and truck drivers, which have been reaffirmed in recent earnings commentary from within the space. And number three, we have an infrastructure bill, stimulus bill coming. So I think this combination is going to be positive for trucking rates across the country. Looking at Morgan Stanley's latest checks and forecasts, first of all, we can see here that the intermodal car loading traffic is expected to continue increasing until the end of the year. Meanwhile, their truckload sentiment survey continues to yield heavily bullish responses, with over 70% of industry respondents positive over the next quarter. And interestingly, one thing that also caught my attention was the bullish commentary surrounding the flatbed truck industry. Basically, flatbed trucks are currently in extremely tight supply across both the Midwest and the Southeast regions, to the point where the respondents are saying these flatbeds are nearly inaccessible. Now, if anybody wants to specifically play the flatbed industry, I recommend taking a look at a company called DSKE, ticker DSKE. I think our long-term subscribers may be familiar with this company. This is the purest play out there on flatbeds because they're the only national company that's completely focused on heavy haul flatbed transportation. They're basically a consolidator of all these companies across the country. So to be clear, this is not the top pick we're going with, but keep an eye on this one nonetheless, because I think there's upside in this stock, especially if we get an infrastructure bill on top of the accelerated activity that we've been seeing in agricultural machinery. In terms of estimates, the street is currently projecting flat revenue growth versus 2020 and just over 9% EBITDA growth. I think there's room for upside here, especially when we take into account all the tailwinds for trucking rates relative to last year. Moreover, the valuation is pretty cheap. I think a lot of it has to do with this business generally being very feast or famine, and also the balance sheet is quite levered. So logically, it makes sense that this is historically a high beta stock. And it reminds me a lot of Titan International, ticker TWI, which was a bullish recommendation way back last year. But that said, DSKE does enjoy high gross margins in the mid-30s, so there is cash generation potential during the good times, which I don't know if it's something the street has factored in. So putting everything together, I guess my main message here is I'm starting to get less bullish on container shipping. We're getting close to a peak. And I think the next transportation play to rotate to where the rates could surprise to the upside will be intermodal, truckload, and flatbed industries. So for flatbeds, there's this company, DSKE. I would just trade it, not get married to it. As for intermodal and truckload, we'll be saving that as a top pick for a Q2 outlook.
Excellent. I love it. Fantastic looking chart over here too. I love it. So this thing is going to break out through the $7 resistance. It has been climbing up to this resistance on rather rising volume with the MACD and RSI powering higher. And you're right about the rates for shipping for trucks continuing to go higher. And there's the setup here for a breakout for that very reason. And we'll save the other one, for the quarterly outlook. This should break out from here. And if we learn anything from that former pick, which was Titan International TWI, which is understandably slightly different, but this was the same thing happened here too, where it was a low priced ticker, which broke out. And at that time, just continued to go higher. What was a $3 stock ended up now trading at $9 per share. That's what happens in a growing economy. And and this is exactly what's going to happen here too, as the value continues to get rewarded with improving growth trends. Fantastic stuff over here. The only thing I will just add to this discussion is that while we're seeing trucking rates should see from lesser and lesser congestion in the ports, trucking rates should improve. I expect the same thing will happen in rail cars too, because the same goods have to be shipped either on trucks as they come out from the port congestion, or they have to be put on the rail cars and then move from that. There's a direct play on that too, and clients know exactly which stock I'm talking about. So I think it benefits both industries, and it all ties together to IYT, which is the transportation index. Great stuff, guys. Thank you very much for joining. And Jax, we will see you in the chat room shortly.